Hello, this is Ambula Vinaka to all the Year 11 accounting students. We will be looking at balance day under the heading balance day adjustment. At the end of this session, you should be able to explain what is a balance day, describe what happens on balance day, discuss why we need to have balance day adjustment, identify the accounting concept used during balance day adjustment. Furthermore, we'll be looking at some specific questions in regard to balance day adjustment. What is a balance day? This refers to the date at the end of the accounting period. So on the timeline that we have there, we have the accounting period, the starting and the ending of the accounting period, and in between is the financial year, and we are focusing at the balance day. What happens on balance day? This is when all the ledger accounts are closed and the trial balance is prepared. The trial balance is a list of all the account balances for the accounting period, and this is used to prepare the financial statement for the year. Since the reliability of the financial statement depends on the accuracy of the trial balance, we therefore must make sure that the trial balance is accurate. Therefore, we must have a balance day adjustment. What is a balance day adjustment? These are adjustments made to the trial balance values due to various reasons. The first one, amount in the trial balance is incorrect due to errors that may have occurred in the preparation of the trial balance. Number two is the trial balance do not show the correct amount for the accounting period. Some amount that may have occurred in this accounting period belongs to the next accounting period, or some amount that are in the trial balance are still due or does not represent the full amount for this accounting period. And number three, due to certain evaluation practices that are carried out at the end of the accounting period. For example, the valuation of fixed assets, we have depreciation and other management practices that we must make sure that we have the correct value of our asset at the end of the accounting period. Let us look at some of the accounting concepts covered under the balance day adjustment. The first one is accrual basis accounting. This states that revenue recognized when earned and expenses when it is incurred, irrespective whether they are cash or credit transactions. This means that transaction earning revenue might occur now, but cash is realized later. So it is not a cash basis, it's an accrual basis where cash is later transferred rather than immediately. The next one is accounting period. The life of the business is divided up into arbitrary time period, normally 1 year. So in this balance day adjustment, we are looking at the periodic yearly basis, because that is where we come to the end of the financial year and we have to prepare the financial statement. The last one is a matching concept. This states that expenses for the period must be matched against the revenue for this period to accurately calculate the profit for this period. So in the chart that is given below, you'll see the revenue and the associated expenses both for the same accounting period in order to calculate, which is equal to correct calculation of net income. So now that we have managed to go through the word balance day, these are some of the topics that will be covered under this topic, balance day adjustment. The first one is prepayment, expenses that are paid in advance. The second one is accrued expenses, expenses due yet to be paid. Number three, income accrued. These are income yet to be received. Number four, income received in advance. So these are the four items that deals with income and expenditures, revenue and expenses, and you will be required to apply the timeline for with the question given to clarify the calculation for the prepayments, or whether it is due or paid in advance, The journal entries, how this particular transaction, each of them affects the profit and loss, and how each of them affects the balance sheet. So this slide shows the summary of each of the four that we have just discussed: the red, prepaid expenses; blue, accrued expenses; yellow, unearned revenue or revenue received in advance; and green, accrued revenue or revenue yet to be received. Please check the other videos for each of these topics that will be covering all these in detail. The other balance the adjustment accounts are, firstly, we have depreciation. Number 5, depreciation, allocating the cost of fixed assets over the useful life. For example, we have a van, delivery van. The first year of the usage of the delivery van, the value is very high. You can see that on the far top right hand side. As the time goes, the value of the delivery van goes down. We call that a depreciation, the reduction in the value of the fixed asset over the useful life. The next one is bad debts. This refers to debtors who are unable to pay up their debts for various reasons. For example, migration, or unemployment, or death. They're unable to pay the debts. So we call them bad debts. And lastly, we have doubtful debts. This is a certain percentage of debtors who the management suspect that will not be able to pay up the debts. So we call them doubtful debts. Through the experience of running the business, you may experience certain percentage of debtors will not pay their debts. So if we have as your current asset, we have debtors $5,000. According to the managers, they know that we will not receive the full amount from the debtors. So part of the debtors will go bad. So they're allocating certain amount as doubtful debt now to write off certain amount that they know that will reduce the value of debtors. So as we come to the conclusion of this topic, you'll be required to have certain skill to be able to calculate the values correctly. This is by using the timeline. As we know, we have seen this timeline, the starting and the ending of the timeline, and then we focus on balance day at the end of the accounting period. Now, the accounting period is normally divided up into 12 months, 1 year. And the example given here is from July 1st to June 30th. Balance day is in June 30th, 12 months. So any amount that you will see that falls short of the 12 month that is due, whether it is a revenue or expenses, or any amount that goes beyond June 30th that is in advance, whether it is paid in advance or received in advance. And the balance day adjustment can also be in a timeline that is in days. It's normally in wages because the wages are normally paid according to the rate, the day the workers come to work. They work every day and the hours that they work. So if they work, in this case, Monday, Tuesday, Wednesday, if they have already worked for 3 days, but they will be paid on Friday. So this kind of expenses is normally determined on a daily basis compared to one that is determined on a monthly basis, like rent. You already know the amount for rent for 1 month, whereas wages, you only know the amount for wages when they come to work. And according to this day, this particular timeline, the balance day is on Wednesday. So by using a timeline, you should be able to use it to determine the dues and those whether it's revenue expenses in advance. And secondly, next we have to prepare the general journal entries. Remember, there will be a debit entry and there will be a corresponding credit entry. That's what we are referring to as general journal entries. Next one is the profit and loss account. Under profit and loss accounts, expenses are normally on the debit side and revenue on the credit side. As you know, according to the matching concepts, expenses for the accounting period, expenses for the year is matched against the revenue for that year, for that financial year, in order to calculate the income or net profit for that financial year. So the profit and loss actually execute the matching concept. Now you must make sure that the expenses is for that period. It means for the 12 months, and the revenue is for 12 months. Any in advance is subtracted, whether it's a revenue expenses, any due is added, whether it's a revenue or expense. And lastly, you're going to see how it affects the balance sheets. And the balance sheet, as you know, current asset on the left hand side and current liabilities on the right hand side. So prepaid and expenses and income accrued usually appears under current asset. They are regarded as current asset. They still belongs to us. Whether it's income we still have not paid or expenses that we already paid, they still belong to current asset. And current liability, expenses due and income received in advance. So that is in a nutshell what you expected to find in the other topics that we have covered from number 1 to number 7. That brings us to the end of the session. This will be available on YouTube. You can subscribe and like and subscribe, and share it to your friends. And thanks for watching. Hope to see you again. Goodbye.